In accordance with Section 8-1, subsection 1, in order to be deductible, an outgoing or loss must first satisfy one of the positive tests, and it must also not be excluded as per Section 8-1, subsection 2. Crafty Furniture is a manufacturer of custom-made furniture. In the tax year just ended, Crafty Furniture purchased a new piece of machinery for $40,000. The expense is necessarily incurred in carrying on a business of earning assessable income in accordance with Section 8-1, 1b. Therefore, this satisfies the positive test. That is, that you can deduct from your assessable income any loss or outgoing to the extent that A, it is incurred in gaining or producing your assessable income, or B, it is necessarily incurred in carrying on a business for the purpose of gaining or producing your assessable income. However, we must also consider the exclusions in Section 8-1, 2. That is, that you cannot deduct a loss or outgoing under this section to the extent that A, it is a loss or outgoing of capital or of a capital nature, or B, it is a loss or outgoing of a private or domestic nature, or C, it is incurred in relation to gaining or producing your exempt income, or D, a provision of this Act prevents you from deducting it. In this case, the outgoing relates to the purchase of a new piece of machinery. Therefore, this is of a capital nature and fails the negative test and is hence not deductible under this provision. As a result, Crafty Furniture will need to rely on another provision, such as the Division 40 capital allowances. It is important to remember that these tests are cumulative. That is, that the loss or expense must first satisfy one positive test and second must not be excluded by any negative test. When it comes to defining losses and outgoings, there are two cases that provide us with interpretations that we can use. The first comes from Amalgamated Zinc and the FC of T. In this case, the taxpayer claimed deductions for annual contributions made to a workers' compensation fund after the business had ceased operating. These payments were a liability for former employees under the Workmen's Compensation Act of 1920. The Commissioner denied any deduction for these outgoings as the payments were incurred after the business had ceased operations, and were therefore not incurred in the process of producing assessable income or carrying on a business. The key point to remember from this case is that an expenditure needs to be associated with or directly related to gaining or producing assessable income in the income year in question. And secondly, in the Charles Moore and Company of WA Proprietary Limited case, where it was decided that what matters is the connection of a loss incurred with the operations which gain or produce the assessable income. In this case, the taxpayer operated a retail store and its employees were robbed while taking the previous day's takings to the bank. The court decided that banking the previous day's takings was a process that was incidental and relevant to the taxpayer's income-producing activities. Therefore, the loss was deductible. To recap, allowable deductions under Section 8-1 are losses or outgoings that must firstly satisfy one of the positive tests per subsection 1 and then must not fail any of the negative tests under subsection 2. It is important to remember that the loss or outgoing needs to be directly related to or associated with income-producing activities in the income year being considered.